The Fed did exactly what Wall Street expected it to do, raising rates by 0.25%. Wall Street right away saw it as good news. However, once Chairman Powell started speaking at his press conference, the bears started to come back in. So what are we going to see from here on out? We have an enormous jobs report that could move the needle for the Fed as well as for the rest of the markets. Well, we're here to answer all those questions for you. Hi, everyone. I'm Todd Schoenberger, and welcome to Buy, Hold, Sell. I am joined by my friend and co-host Tobin Smith out in sunny and hot Scottsdale, Arizona. And
Finally,
Toby,
it is sunny and hot. Finally, it is sunny and hot.
I can see you don't even have the blur behind you because it's so sunny. It looks gorgeous there, I gotta say. So Toby, you and I have been just going nuts with this whole thing with the Fed. We've been talking about it leading up to the big moment today. And now they come out 25 basis points, which is exactly what we expected. However, we're also thinking that maybe we would hear a definitive pause. What do you think right now? Where do we go from here?
Well, Todd, here's the two things I know for sure. Number one, the Fed sitting behind closed doors has a conversation that's sort of like this. Okay, we can tank the economy or we can blow up some banks. We'd rather blow up some banks than tank the economy, right? All things being equal. But they were going to get one or the other, and they were trying not to have both. And clearly, I've been going through a number of sort of the data on the banks in the United States. And without getting too jiggy on it, I'd say right now about half of all American banks, and forget about the top do not fail banks, although there's one do not fail bank on my list that's got about $1 trillion. They're upside down, meaning their assets versus their liabilities, and their liabilities are their deposits, right? For some reason, the Fed doesn't think that with social media and the cyber world here, that deposits just won't disappear. And the fact is, they are disappear like you. What's happening to you, brother?
No, I'm here. I'm going. I'm with you. I'm okay. Looking at the terminal here, and I'm wondering because everything you're saying is exactly, you're talking about the banking sector. Take a look at the Spider S&P regional bank ETF. I'm sure that's where you're going with this, because banks. What are banks going to do? Because they were up earlier. Then once the chairman started speaking, everything went south.
Well,
what do you think is going to happen in that sector?
I've just been saying this for a while, and this is no prejudice against 30-something-year-old money managers or hedge fund managers, whatever. But I swear to God, Todd, it's hard for them to imagine. They've never been in a situation where the Fed, had this sort of massive dilemma, and we're going to pause. Remember, we would have 3 rate cuts, October, November, December, because the job is done. Hey, right? But the job is not done. And my favorite one, there's a young person who won't be named, who put something out today and said, hallelujah, we finally hit the last point. June, we're not going to raise. We're going to get these cuts. And you know what happened, Toby, in 2006, when they stopped at the 7%, at 6% rate, we had a bull market up 20%. Now, I would just like to suggest that the history of 2000, 2006 and the history of 2020 to 2023 have nothing in common whatsoever.
Absolutely nothing.
There was a banking crisis, but that was 2 years later. And we had just come off this, essentially, not that I have gray hair or anything, but I had very, beautiful blonde hair running a hedge fund and a mutual fund. There was essentially, on the hedge fund, we could be short and long. And the hedge fund, I would be short, because we went down 30%. Yeah. And we came back 30%. And then we went down 30%. And then we had 30% moves between 2000 and 2003. And everybody was just, I hate the market, so I'm going to start buying homes because I can get, a loan to do nothing, right? And then we had our bubble there. Well, we're nothing like 2006 right now. And the piece that I think that the Fed can't say but is doing is they sort of had to make this decision. Are we going to tank the economy, and that will get inflation down because unemployment will rise, or we're going to break some banks, and of the two, that's okay. We'll break some banks. And I went through the numbers today, Todd, and about almost 50% of the banks that have deposits and then buy assets, et cetera, if you take the toxic commercial loans they have, and particularly, what most people don't really understand is that, like, when you buy, I'm a business guy and I'm going to buy my office building. Well, here's what I get. I got a mortgage loan. I got to put maybe 10% down. That's fine. But that loan rolls over after 2 to 3 years. The rates change. And I got to essentially refinance it because they're not going to finance me out, for 30 years. I'm not building Citibank Tower in New York, right? So now we're coming up to that point where they're going to roll this stuff over. At the same time, mortgage rates are, for commercial is 8.5%, maybe 9%. When they loaned it to me the first time, my rate was 2.5%. So,
Yeah.
I carefully thought about this, Mr. Bank, but I could afford the rent then, but I can't afford, the mortgage, and because I can't actually, I had my rents go down 20%. So that's
right.
toxic. Then the other toxic part, obviously, is it's not just Silicon Bank and other ones that bought 10 and 20-year securities, and then all of a sudden the money they bought it with, aka deposits, went out the door faster than a rat on a steaming hot ship, and all of a sudden they're pow. So right now, the banks that I look at, and then look, the whole banking system, we get a data feed and it tells you everything. They're about $2.5 trillion upside down today on what the assets they used to have were worth and what they're worth today and what their deposits are. And so any bank run can take these guys down. And I'm talking about 2,000, 2,300 banks that are completely upside down. In other words, the assets they bought with their deposits are worth significantly less than the deposits. So when the deposits go out, they got to give the money back to the deposits. And if they sell the treasuries, they take a loss and they go bankrupt. So we're not getting this from the mainstream news. We're not getting it from CNBC. That the banks had to make a choice, and they chose that. Okay, the Federal Reserve will take some banks down with them, which is better, all things being equal. I mean, we've already had people are like, hey, we've already had $24 billion of losses already. Because everybody looked at the deposits and but how about the preferred shares? The preferred shares, and banks usually sell preferred shares, and they get a little money and they pay a low interest rate, but it's preferred, it's safe. Well, it's not safe. It's not guaranteed by anybody. So, man. Right. So we're missing that story.
There's a lot to unpack there, and I think your take there on the banks, and you are right. Our audience is not going to hear that information from the likes of CNBC or Fox Business or any of them right now. So
they're not going to hear from the federal government, Todd. That's the one that always concerns me.
I think, but back to your original statement about these strategists and all. I mean, it's complete horseshit, because what they are expecting is this to be easy. And the Fed is still trying to figure these things out. And that's why they are continuing to keep things open-ended by saying, look, we are going to remain data dependent going into the June meeting. I completely understand that.
I want to show you something there, Todd. I know that people at home can't see that, but
they will in the video.
I know.
Oh my goodness. What is that?
The last 4 months.
Is that for the bonfire in the back? What is going on?
No, these are articles from major magazines, newspapers, so on and so forth. And it's literally like half and half. The one on the top is the world's going to shit. The bottom is it's all right. Nothing. There's too many moving parts for anybody to actually put a solid strategy together, except for if you're a stock market investor. Geez, if the momentum is up, buy the momentum. As soon as the momentum changes, sell the, and just take profits while you can, because we just don't have any analog. There's no model that fit in everything else. And that was until we started having banks runs. Now you have bank runs, and then all of a sudden, I have a credit line from a B of A. I got a notice today that if I want to borrow money on that credit line, it used to be 4.5%. It's now 9%.
Wow, incredible.
And I got good credit, but
Yeah,
I'm not going to pay what am I doing?
yeah. Why would you? You'd be
Yeah,
stupid
I mean,
to.
unless I was
Yeah,
paying off an ex-wife, which would be
yeah,
worth the 9%, by the way, Tom. Then it makes the cost of borrowing.
yeah.
So I'm just not going to, add something, or I'm just not going to try to acquire a company or yada, yada, yada. So
Right.
when that all goes, starts leveling down, and then you look at the 250,000 tech jobs, which, by the way, so the average salaries, believe it or not, certainly in Silicon Valley and New York and other high tech areas, is about 250,000 a year. There were
Okay.
a lot of $500,000. That was the news this week. The 500,000 a year people having a hard time getting paid $500,000. At ADP to program
Right.
stuff for OT. Well, if the average wage in the United States is $38,000, what it is. So let me do the math there. So at 150,000, that's like 5 times the impact. The 500,000 people, that's like 14 times the impact. So you can lose 250,000 highly paid tech workers, but that to the economy, that's like losing $1.5 million just regular jobs. And we're now starting to see it. We saw one number this week about how retail spending came up, but that was not seasonally adjusted. And now every day you're seeing this. McDonald's 3,000, Deere 4,000. Every CFO, the CEO, has got him in the office, and they said, "Listen, Todd, look at me. You need to cut 8% of our overhead because we're going into a recession." We had the recession. We've already had the recession on the leading indicators. The leading economic indicators, the LEI, is down 9 months in a row. It's contracted like this. That's the leading stuff, right? So we've already had sort of that recession. Now we're actually going to get the actual recession in the real-time GDP, and it's happening because these job layoffs, because of bank crushing, because of the stock market going nowhere, et cetera. People are going to say, "I'm going to sit on my hands here."
Well, one thing about this recession, we've been talking about this recession for months, actually, since the Fed started tightening. I mean, today is their 10th hike, and we have yet to hit the recession. I mean, it might feel like it, or the data might point to it, but does it feel like it for Americans? I think it will, but it isn't there yet. So the question is, when does that happen? We could talk about an earnings recession. Yeah. We could talk about credit constraints. We could talk about banking failures over and over and over again. But my definition of a recession is we look at negative GDP for 2 quarters in a row, but you also are feeling it. You have no cash. You have nothing. You can't do anything. And then you start seeing the big layoffs, the big bankruptcies. Your local pizzeria goes out of business. We haven't seen any of that yet, Toby. So the question is, are we going to be seeing that? And if the Fed does pause and they keep where they are now at 5 to 5.25% for the rest of the year, is that going to be enough that says, okay, we're going to see inflation going down to that 2% target, but is it enough to push this economy into that recession that we've been talking about?
Yeah, well, I mean, again, in a traditional sense, yes, the rule is 2 negative quarters in a row of GDP. But we had 2 negative quarters of GDP last year. If you look at the Atlanta Fed's GDP now number, number one. So number two, I love how the Fed had said, well, Silicon Valley Bank and FRC, they're idiosyncratic, right? I just love the word idiosyncratic.
Hashtag
idiosyncratic. So what they're trying to say is, well, yeah, Silicon Valley Bank had a high concentration in startups. They also made the startups who got venture capital money put that venture capital money in their bank, and so you got this huge influx of deposits in the 2020, 2021 when A, money got free, and B, we had the tech craziness, right? So, and First Republic, sorry. I had a company called First Reliance. It's just very hard.
Well, there's Western Alliance.
The Western Alliance, right?
Yeah.
Those guys are the same thing. But when the Fed got in there, Todd, it was like, we just lent Mr. Smith $5 million on his house with no principal payments for 10 years. I'd only be paying interest. if I had a $5 million house. And but Silicon Valley, $5 million house, I had $5 million condo. I mean, my favorite story is a kid who worked for me at Phillips Publishing. Worked for 2 years. He was great. He's from Harvard. Like 2004, he says, Toby, I'm going to leave. And I said, Tommy, you can't go, man. I mean, actually, his name is Todd. Todd, you can't go, man. You're the man. And I said, yeah, my roommate from college, you may not know him, Mark Zuckerberg, he has invited me to come and, take everything I've learned here with you at Phillips Publishing, and I'm going to take it to Facebook. Yeah. So he calls me like a month ago and says, Tobe, listen, I'm coming out to Scottsdale. We live in what we call is the Silverleaf ghetto. Silverleaf is like the, Holmby Hills of Scottsdale. It's up in the hills, and every house is like, 8,000 square feet. So I take him up there. I take him to a house next to John Rahm, who's now the world's #1 and the, Masters champion. And he only made $120 million last year. So Todd buys a house next to John Rahm. And I'm just sitting there. I said, well, Todd, don't you want to negotiate? He says, no. He pulls out his checkbook. He writes a check for the house. The realtor almost crapped her pants. I don't think she'd ever seen anything like that. I thought he was going to just bring his American Express card out and buy it, but the points would be too high. My point is that those days are gone. He's already lost about 15%. This is actually in December on what he paid. I mean, he was like, that was the ultimate top of the market, Tom. When a guy writes a check out of his checking account or his Merrill Lynch account, that was, to myself, I'm saying, this has got to be.
You hit the peak.
This is got to be top, right? So, we're not through the cycle yet. And as I say, the Fed has said the lesser of two evils is let these banks go. Well, when these banks go, there's, as I'm saying, more than 50% are already technically insolvent. There was a law years ago that said you wouldn't have to, the word mark to market. You would say whether your 30-year bonds are actually down 25% if you had to sell them today. You don't have to do that for a variety of sort of accounting arcana. And now all of a sudden, dude, they're insolvent. And in the age of social media, where I can put a rumor out that this bank is having a run, depositors can get on their phone and withdraw. I can take deposits out of Bank of America in 5 seconds.
Well, that's something actually that came up. If you're after the press conference on Bloomberg, they wondered if the Fed actually knows how fast you can withdraw money because you're going onto your mobile app. And that's incredible. How could you not know this right now in 2023? They were almost stunned by the fact that so much money was withdrawn so fast. I guess they figured people are going to show up with their passbook savings account, going up to the teller window saying, hey, Denise, good seeing you again. How's Bobby? And by the way, I'm withdrawing $10 million right now. I mean, it's ridiculous.
I just did a cashier's check for $10 million. I hope that's not a problem.
Have a good day. Tell your husband I said hi. I mean, can you imagine? I mean, that's it's insane to think that they would not understand technology.
I was having a conversation with a friend up in Silicon Valley who did have an account there, and let's call him Bobby. And I said, Bobby, dude, wire the money to Bank of America or JP Morgan, and I could do it for you in 45 seconds, but I'm going to charge you $10,000 to do that, you lazy POS. So sure enough, we're like doing a Zoom call and say, okay, you do this and you do this, boom, 10 million ish gone. And that's when the VCs were on Twitter saying GTFU out of Silicon Valley Bank. Oh boy.
Well, I'll leave you with this final thought, and we'll while we close this out. But at First Republic has an advisory business, as you know. And so you have a ton of advisors. These are registered investment advisors affiliated with the bank, with teams of people managing tens of millions of dollars. Once they started jumping ship and they started going to
240.
240, yeah. They started going everywhere. They started going to competitors. That was the end of it. Yeah, bye-bye. And you knew that once the advisory business rolled out the door, that was going to be the end of them. But listen, let's leave it at that block because we want to get further into this about the Fed. We also have a big jobs report coming out. We still have earnings that are taking place. We can talk about Starbucks as well, Toby. I got to tell you, that's the whole thing. You got to get back to eating those egg white bites or whatever that you like.
I love those egg white bites.
I know you do, but you're not eating enough of them. All right, so please stick with us. We'll be right back after the break.
Hi, everyone. I'm Veronica Dudo, and welcome to Buy,
Hold, Sell. If you have the Russians that are going into Ukraine, the Americans and the Germans and everyone else in Europe is going to say, hell no.
If Russia doing things, logically was their MO, I'd agree with you. Yeah, Todd, why don't you get him on a phone call right now? Hello, you.
Welcome back to Buy, Hold, Sell on this Fed decision day. So as we were just mentioning in the last block, the Fed did hike rates again by 25 basis points. They now have a Fed funds target of 5 to 5.25%. It's the highest we've seen, I think, Toby, since 2007 or something crazy, right? Is that right? Yeah, 2006. So, and this is a 10th straight rate hike as well. And actually, at first, it was good news. Then all of a sudden, the bears came out of hibernation. We saw the Dow down actually over 270 points today. And this is on top of what we saw in the sell-off yesterday. Yeah. So the question remains, what's going to happen next? Now, we have a big jobs report coming out on Friday. And then you have the big CPI data coming out next week. Plus, we have earnings right now, Toby. That's something we didn't even talk about. What's your take on the earnings season? We saw Starbucks come out. Yeah. The stock was down over 9%. I thought China opening up was going to be a huge thing for Starbucks, but it turns out not to be the case.
Well, first off, I think the number is 2/3 of the Starbucks over there are franchises. They're not owned by Starbucks. So they're just getting a royalty fee. Talk about confused, or you can have one company. I mean, SMCI happens to be one of our favorite stocks, and it was up 25% today. Why? Mm-hmm. Because they sell the connector. When you have an NVIDIA chip to run your AI cloud computing, you have to have an SMCI connector, right? And their sales are up crazy. It's awesome. Then Qualcomm comes out, which also makes a connector and a GPU, and they're down 8%. Same thesis. You have a yin for a yang for every stock that has positive earnings. Another one in the same business or the same line is down. Another one I love, by the way, I love Wingstop. First off, I know you love Wingstop because you have teenage boys. So all you gotta do is call Wingstop, send me over like 5 barrels, right?
I drove by a Wingstop yesterday, and the first person I thought of was you, Toby, because you talked about this company before.
I love it. The average footprint is 680 square feet for a Wingstop store, right? They have very small real estate. They only do chicken wings. They added a sandwich, which was even, I love the sandwich, by the way. It's the best business model in town. They franchise, but they also sell them the chicken and everything. They have massive own wings. Will never sell wings, right? But for every company in the same industry, the same space, one good earnings,
they'll mix it up.
Confusing. Yeah. It's just so confusing. Mm-hmm. So the things that I'm absolutely sure about are if you could fit into like this coffee cup, but the ones I'm not, you could put into a giant bathtub or a hot tub outside. I and everyone else. That's why we're in this range. We get to 4,200 on the S&P, and it's like me trying to date Gina Lollobrigida in 1970. I got the address, I got the phone number, never got past that, right? Or Raquel Welch. So let's use Raquel Welch.
Raquel Welch, yeah, that's what everyone would know. Yeah. Raquel Welch.
Boom, nothing, right? And at 3,800 down here, see, remember at 4,200, the S&P is selling for as high a multiple on its earnings as it did in the craziness. So so you can't say they're bargains necessarily. So we are being very, very specific in that I'm not buying the market. I mean, you could have bought the QQQs. Remember the 9 mega cap stocks, only 9 in the S&P 500, and in the overall market, delivered 94% of the positive return this year.
Yeah.
Now, that concentration, again, makes the craziness of the last 8 years, look sane. So where do you hide? Well, one place you hide, and this is why the banks are getting crushed. Again, I'm going to that thing. Hey, BOA, or I'm on my app. Take this $10,000 deposit I have and move that into the money market fund. And this is what's happening to Schwab right now. Schwab is my next door neighbor, is a senior VP with Schwab. We were talking, I won't mention his name, but we were talking about every day. He's on the bond side and the wealth management side. He's saying every day they're getting about $150 million to $250 million transferred from just deposits to their own money market fund, which is paying 4.5%.
Yeah.
And when everything was, there was no interest rates, when everything was free, when free money, yeah, I'll keep it in the, there, I don't care, because I'm not going to get anything better anyplace else. And I don't want to get locked into 10 or 20 year bonds, right? When interest rates are going up, that's bad. Even the individuals knew that. Silicon Valley Bank didn't know that, but I mean, the average person is, wait a minute, if I buy this bond and interest rates go up, then bond values go down. So I'm not going to do that, right? But now, $250 to $300 million a day going from their deposit, because remember, they have a bank. Those deposits were paying 42 basis points, 0.4%. That is just going to accelerate now. And now this ridiculous spread between what you can get in a money market account and deposit. The only one that is positive is Interactive Brokers. At Interactive Brokers, that's where we have our managed accounts. We get 4.5% on our brokerage account. We don't have to put it in a bank account or a fund, right? So that, these are not fast problems, Todd. These are slow, everyday problems. There's not a machine gun. This is like a rifle, elephant bullet, and every day some bank, some company, etc. So that's why I think this recession is just such slow rolling.
Okay.
Because of the mismatch in employer, and then secondarily, we really didn't get the banks had a free ride for a while. Now all of a sudden, now they're going to have to pay 3% on those deposits, so they're going to lose them.
So let me ask you this.
Yeah.
Here is a question for you. Would you be a buyer of regional bank stocks right now?
Yeah, I would not, and simply is because there's so many hidden bombs there. If I was, really confident in a bank analyst who really was on top of it, I'll send you tomorrow what I've been doing, that I've been, borrowing, should I say, from some really good analysts and a bunch of Brit analysts, by the way, guys that I've known for years, that they don't have any axe to grind. They just look at the numbers and they say, hey, Toby, it doesn't add up. That's where I got the $3.5 trillion of essentially unbooked losses and only $2.5 trillion of equity.
Yeah.
So, you have to pick your spaces very carefully, obviously. There are stocks and sectors that are doing well for us that have to do with shipping and pipelines and stuff that, doesn't work. But now let's throw the third thing on here. If Europe is already in a serious recession, I mean, an actual negative GDP recession, take all the various, Germany's worse than the UK, and France is can you believe the French are now the smart people? They have the strongest economy in Europe. I love that. It's because all those baguettes. It's all the
They have the
baguettes.
best coffee. They have the
best coffee, no question about it. And the best wine. So, but you take it in an aggregate. When you remember, whether you like Donald Trump or not, one thing that I liked about him was that he went to Europe and said, hey, we're paying 2% of our GDP for defense. You guys are paying like 0.2%. So now they've gotten on the bandwagon. So now, they're actually putting money into defense spending in a big way, but that's, draining their reserves. And most of all the stuff they're buying is from the United States. They're buying some jets and fighters from the UK, and they're buying some tanks from France and Germany. But on the whole, where do you get the ammo? The state. So we're in a slow rolling world global recession. When you look at the price of oil now, which remember was down to like $64 in March, then it shot up because the Saudis said that, hey man, we're going to cut 1.5 million barrels because we like to keep the price above 80. Went above 80, $82. And then all of a sudden we look at we look at the recession, and you put it in your formula into your program. And my program says that we're down about 7% on demand for oil. And you know what that does? That brings the price down. And so now we're in that situation where, oil does affect inflation, but that's energy and food are not part of core inflation. But still, all in, oil prices are coming down. So we sold a fair amount of our oil stocks, which we had huge profits on. But I'm saying is that you could look at all these sectors, Todd. I'm trying to make this easy, and it's not. If you looked at 20 different sectors, you have to make a hard call on each one of those, because some benefit, some don't. It's not like, you know what, buy the QQQs on the dip. Hey, it worked for 12 years in a row. And I think people are complacent. And I have a friend that I would do that for. He's too cheap to pay me than 1% to run his money, and he's too much of a pain in the ass for me to run his money.
Yeah.
I just send him a text and say, buy the QQQ, buy the QQQ.
Yeah.
He did 25% a year for 10 years. And then when I told him to sell them in January 2020, he sold them, and then he had to pay taxes, and now he's mad at me. So the moral of that story is never do a favor for anybody.
Well, that's because he's a cowboy, so he has his own way.
No, he's a Kansas City Chief. There's Kansas City Chief.
Oh, that's what it is.
He played for the Chiefs, so
I got him mixed up.
Yeah. But anyway, I guess my point is that if your horizon is 20 years, 30 years, then absolutely, particularly your 401k or in something that's monthly, just keep putting it in half in the S&P 500. I like buying the equal weighted S&P 500 because it particularly in these times, it's up more than the regular S&P 500, because the S&P 500, as we all know, is, what's the number today? 39%, 8 stocks, a little overweighted. And then don't start buying bonds yet. But as soon as we do get a point where interest rates are coming down, people totally forget or never knew that we were on a bond market, bull market. In other words, interest rates coming down for, I don't know, the first from 1982 to 2006. We made almost 18% a year just in bonds, 10-year bonds.
Solid.
Doing nothing. Right? People, and then all of a sudden we got into craziness and the dot-com mania, and people, no, I never want to buy a bond. So,
well, in regards to your bearish sentiment on the regional banking sector, and you're not alone. The S&P Regional Banking Index was down 6% at one point today, and this was after Fed Chairman's remarks following the Fed rate cut. So, going forward, you're right. It's just too dangerous right now. It's probably an area I think most investors probably should stay on the sidelines.
Yeah, I mean, if you bought them on Friday, and the last crash, they went up like 3%, but now they're down.
Right.
So that's what's the term? Don't catch a falling knife. In this case, don't catch a falling safe. It's just there's too much intrigue. And as I say, the FDIC came in and they were saying, what if we just cover all deposits? So there's no risk to the deposits. That will stop this. And about 30 seconds later, somebody got into the Biden administration's ear and says, if you do that, we're going to have the New York protests again, because you're just helping the rich people. And in fact, since what they were saying is they were going to protect deposits over 250,000 unlimited, you were absolutely helping the rich people. And in an election year, that would just be, DOA.
Well, you bring up politics, so we'll actually dovetail into that subject. Well, it is reality, and right now in the United States, there are approximately 4,900 different banks, and clearly most of them are regional banks. So, and they're all in every jurisdiction, and you're around the country. So naturally, any politician who is representing that district is obviously going to have a number of these regional banks. So last thing you want is your regional bank to go under, especially if we're coming up to an election year next year. That's why it gives the impression that you won't have bank failures because of the politics involved. But that did nothing for the other three that we already heard about over the past few weeks.
The other intriguing thing I got from my Brit bank analyst friends was that if you read between the lines and you talk to people who are inside the room, part of the FDIC's big strategy was what if we just throw that out there,
Mm-hmm.
then the average dipshit American is going to believe it. And they're going to say, yeah, the FDI, everybody's covered. So, don't worry, Mabel. And then when they pass that by the White House, they said, are you crazy? I mean, I remember I would walk down to my apartment in downtown New York and go through all the demonstrators sitting in, what's its park? I can't remember.
Zuccotti Park.
Zuccotti Park, right.
Yeah.
And I'd be wearing a suit and I'd have like makeup on from Fox. I did that once.
Big mistake.
Big mistake. I have never been called names like that. And I've been called a lot of names, Todd, but I have never been called names like that. So that's off the table.
That was scary.
Yeah. Oh, it was very scary. I mean, you didn't know they all had tents and shit. I didn't know whether they had guns or spears or whatever.
Yeah.
So anyway, my point here is that since that's off the table, there is no blanket because you could solve the problem in a minute. And if they did that, you would see the Dow up 1,000 points. I guarantee you would see that regional bank thing like crazy. But politically, they can't do it. In an election year, they can't do it.
Yeah. On a side, I remember walking to the office and passing the protest at Zuccotti Park. And I mean, I took a glance over. Oh my goodness. And even with NYPD there, I was still nervous as hell. I just quickly crossed the street and kept walking. I was a quick walker to the office that day and never did go by there again.
Yeah.
So definitely.
But can you believe the FDIC, according to multiple reports, just felt if they threw it out there that they were going to guarantee all this, that people would just assume, right? Because gosh, they remember they used to started at 50,000 guarantee, and then he went to 75.
Yeah.
Then we had those savings and loans. I mean, people forget, Todd, and you're not even old enough, you little schmuck, that savings and loans, which were my main client in the 80s.
Yeah.
We closed 1,600 savings and loans between 86 and 92, 93. We had the bankruptcy of Orange County, which had a bunch of money in a savings and loan that went, south. People forget that. And to say that in this case, first off, we knocked out a lot of savings and loans that never came back, right? They all sort of rolled up into big players. And remember, savings and loans for a long time, the only thing they could do is issue a mortgage. They couldn't do anything, right? So we understood that interest rates went up, real estate went down, it crashed, they blah, blah, blah. I understand that part. But to just blithely think, now that the Fed's hands are tied, that they're going to run into the rescue here. And when you listen to Powell, as I've said now for the 435th time, I was with my twin brother last week. He was staying out here. And every time I tell a story for the 5th time, he'd go.
Oh, yeah. Yeah.
Okay. All right. So I've said this story before, but they can't.
No, I get it.
Yeah. I mean, they can't. It's one of the other. They can't do anything about core inflation because they've raised rates as drastically as ever. There's a 7 to 12 month lag. The 115 PhDs at the freaking Federal Reserve in DC, they know all this stuff. They know that if you have 6 million people available for work and 11 million jobs, that wages aren't going to come down, particularly since we're a 70% service world.
Right.
And it's a slow death. And my other pile of papers, I have the companies that have just laid off people, 2,000 here, 3,000 here, 4,000 here, 5,000 here. It's a slow drip, and people can't deal with a slow drip. They need instant gratification. Or as I used to say when I was dating girls, instant gratification is too slow for me.
That's awesome. We could go on and on and on, Toby. You know that, and we could talk for days about this. And I know the audience will love it as well.
Well, after at home, cash 4.5%. B 4.5. Wait for the Fed to really start to cut rates, but they never cut rates ever in the history of the Fed until there's an actual recession, and that's what people don't get, Todd. They think, oh my God, the market is forward-looking 6 months. No,
right.
We have never ever had the Fed cut rates until there was an actual recession called. And until that, all these namby-pambies who don't know what the F they're talking about or are not old enough or smart enough to understand this, and they're going to throw money in, and yeah, they did great. You know, they're up 8% on the QQQs. And by the way, if they were doing it from October, mazel tov to them. You know, they're up maybe 25% or so. But this ain't your old, you know, this ain't your teenager stock anymore. This is completely
it's not
different. Yeah,
it's not your namby-pamby stock market anymore. That's the way you put it. That's great. So listen, we're going to close it out there. But coming up Friday for Buy, Hold, Sell, we have Jeffrey Hirsch from the Stock Traders Almanac is going to be joining us. And we also have a special treat. The three of us are going to give you our Kentucky Derby predictions. Plus, it's Cinco de Mayo, so you know it's going to be exciting. Toby promises to wear a sombrero for the show. So you definitely will be a can't miss.
Ocho cabeza no tiene, you know, aperto, pero it's not one big enough. Mexican heads are not 8.
Very
Trust
good,
me,
though.
I've been trying for 50 years to get a Mexican sombrero. It doesn't work.
You get one of those 10-gallon cowboy hats. There you go. So listen, on behalf of Tobin Smith, I am Todd Schoenberger. Thank you again so much for joining us today on Buy, Hold, Sell. We hope to catch you next time. Take care.
Here. Aloha.
All right.
I want you to smash that like button.